If you watched me in the past, you follow me, you know that I'm going to tell you when there's risk in the market and to be careful. You also know that I'm going to tell you when risk is diminished and to be invested. I'm going to look at both sides of it. What I have found from the so-called experts that this is a time to be invested. If you're not invested, it's the time to get invested. That's what I'm hearing. And I'm going to give you some information on that because I look at it from both sides. I look at, okay, what's wrong with the market? And I look for that. When there's something that's right with the market, it's like, okay, things are positive. I'm going to tell you that. I try to approach it without a bias. And so what I have found, I'm going to show you the material I found, the quote experts I found, and what they are saying. They are positive right now, and I'm going to give you some information that will support that. So thank you for watching. My name is Ben Reppond. Today is April 16, 2024, and thank you for watching. So I'm going to begin with a piece from Dan Ives, who's a contributor, CNBC, and Stephanie Link, same thing. And they believe that you should be invested in equities right now. So if you are, my takeaway on this is, if you are, stay invested. If you're not, get invested. That's their view. And that was as of this morning. So I take that. I mean, they're both credible. I'm just going to play that, let you hear their rationale, what they think, and it's a positive view. And so how you make money, or at least how I make money, is I make money by buying and then selling. Buying at a lower price, selling at a higher price. And there are people who can make money shorting. They short at a higher price and buy back at a lower price. I understand that. But from my view is I'm trying to look for when to be invested and to buy. And when risk is too high, my approach is not to short, but to go to money market. So what they're saying, I'll let you listen to it. Don't go to money market. If you're in money market, get invested. So you can take a listen to Dan Ives and Stephanie Link.
What did you see? How did you see the action that we saw in the tech sector last week? How do you see investors, or how do you believe that investors should play it going forward?
I think it's nervousness, just given the overall market, geopolitical, and everything going on with the 10-year. But look, I think it's a get out the popcorn movement. I think this is going to be a robust tech earnings season next few weeks. We view this more of a golden buying opportunity, given what we see in cybersecurity, the AI revolution, and digital marketing and advertising that's trending ahead of expectations. And that's our view. This is not the time to run. It's actually the time to own the winners.
All right. So Dan Ives is bullish right now on tech, saying this is a buying opportunity. Steph, how do you see all this? I mean, we got earnings season coming up. We're seeing earnings expectations continue to fall. Right now, how do you view the action that we saw in the market last week? As someone who obviously advises clients, how are you advising people to play the markets this week?
I think it's pretty remarkable, Frank, that we're only down 2.5% from all-time highs in the S&P 500. And in the past 16 months, we're up 33%. We've had to deal with hotter inflation, an unknown Fed, bank earnings on Friday, which weren't great, but I don't think, by the way, they were as bad as they reacted. But nevertheless, it wasn't good. We have the geopolitical issues. I think the reason we're bouncing back today is because Israel was actually pretty successful in terms of shooting down 99% of the missiles and drones that came at them. We don't know what their game plan is, and I think that's the reason we're going to stay volatile. But I want to step back for half a second and say, why exactly is inflation hotter than expected? Inflation is hotter than expected because we've had an unprecedented amount of fiscal stimulus in the system for the past 4 years, and that is acting as a nice tailwind for the economy. We're growing above trend, and that will lead to better than expected earnings. And I agree that with Dan that technology earnings will be good. But the thing is, other sectors' earnings will be good, and some of those sectors have really, fallen by the wayside. And I think there's your opportunity.
Okay, one of the things that's a risk out there, that is a risk, and it does create uncertainty in the market. So this could change overnight, and that is the Iran-Israel conflict. So that does not seem, it seems with all the missiles that were shot at Israel from Iran and the potential risk over the weekend, it seems to have diminished. But that could change, as I said, literally overnight. So she does address that. So Sylvia Jablonski takes again the view that Stephanie Link and Dan Ives take, which is this is a positive place for the market. Stay invested or get invested. It is time to pick up some winners on a pullback, and we've had a little bit of a pullback, nothing significant, and she's saying take this opportunity to be invested. So take a listen to Sylvia Jablonski.
Joining us now for a look at markets ahead of the opening bell, Sylvia Jablonski, CIO and CEO at Defiance ETFs. Sylvia, we were just chatting a short while ago about how we haven't really experienced this flight to safety trade, the safe haven trade that I think many people may have expected had it not been so clearly telegraphed on Friday, leading to, in part, the sell-off. What do you make of the pre-market activity this morning? And do you agree with Mike that the market has other things that it's focused on right now?
Good morning, Leslie. Well, I think there are a couple of things going on. So first, because of the news going into the weekend, we saw this kind of flight to safety and hedging. We saw a pickup in metals and gold and oil-related products and alternative investments. And I would expect that to happen. I don't think it's going to necessarily propel forward. But I do think that there's enough of, it's sort of cheap enough to hedge, and there's enough of a good reason to do it just because of geopolitics and what we saw. To Mike's point, he makes a really interesting point. What's the difference? I think there was this, major strike this weekend, but prior to that, there always is this instability in the region, and there has been for a while. And so I don't think that people necessarily, kind of panic and come out of growth stocks and high risk stocks and go completely to safety. But I do think you'll probably see some pickup in like VIX, alternative metals, and different hedging types of products in the near term.
Do you think then that the markets may have overreacted a bit on Friday, especially to earnings, because there were these overarching concerns over inflation and geopolitical issues? Or do you think the market has been appropriately pricing in earnings so far? And what does that portend for the rest of earnings season?
So it feels a little bit like it did when we first got the news about Russia and Ukraine, right? You saw the market kind of have this stark reaction right out of the gates, and things started to slow down and stocks fell and things like this. And so I think that there was a bit of an overreaction in terms of earnings and pulling back estimates. And so that probably bodes well for earnings season. I do expect earnings to look pretty good, particularly coming out of tech. And so the bar is pretty low, although the expectations will be high to now beat this low bar. I do think it'll come to fruition. And then in terms of just what we've seen in the last 3 weeks, of course we've seen people hedging and picking up energy, metals, and things like this, but tech has fallen for the last 3 weeks, right? So for an investor who's been sitting on the sidelines, now your Microsoft and Google, Amazon, some of the chip names and things like that have fallen off of all-time highs, and maybe we'll start to see some of the cash going that way.
So this is a commentary from Bloomberg, which is a commentary on the earnings that came out from Goldman Sachs on Friday. They blew away expectations. They far exceeded expectations on every metric. So, and that, again, is positive for the market. Things, in their view, are looking up for equities. So, and you'd say, okay, well, what about Citibank and Bank of America and Wells Fargo? Okay, this Goldman Sachs might be a bellwether for those other financial stocks. But it is certainly, again, when you combine it with the two previous videos that I just showed, it is a statement that says, stay invested, and if you're not invested, get invested. And the key on this thing is over what period of time? Over the next hour, over the next day, the next week, the next month? I think they're looking out for the next year. Maybe to the end of this year, maybe to the election, maybe 12 months from now. I don't know, but a kind of an intermediate term view. So from that, I think that's kind of the view that is being reflected by the Goldman Sachs earnings. So take a listen to this. It'll give you another perspective, but again, kind of saying the same thing: stay invested or get invested. Take a listen.
There are almost no misses in this report, and when we say they beat by a lot. You look at their return on equity, for example, they came in at nearly 15%. The market was expecting 11%. You look at fixed income trading, it more than doubled from the prior quarter, and it beat JP Morgan on equities, coming in above where Morgan Stanley is expected tomorrow. They not only beat their expectations, they set the bar higher in all those traditional investment banking businesses. And remember, John, Goldman coming into today was trading at a lower price to book ratio than all of its investment banking peers, besides, of course, Citigroup.
Let's take one line, fixed sales and trading revenue. You went there, 4.32 billion. The size of this beat, the estimate 3.64. Is the pie getting bigger, or have they just taken someone else's slice this quarter?
Well, that's interesting you ask, because of course we've lost some banks in the last couple of years in this business. But remember, Goldman is sending out a calling card, and that is we're willing to lend. We're willing to lead with our balance sheet. It's not just about the idea of volatile markets here, it's financing. They had a record quarter of FICC financing, as well as the second largest quarter ever in equities financing. And so you're looking at Goldman leaning in more on those traditional businesses and saying, remember that consumer foray? We're almost done with it. A lot of those figures, those messy figures that you used to see in that front page for the last year or so of Goldman, that is almost gone. It's in the tens of millions now. They're cleaning up their act, and they are leading on the businesses that they've always known best.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And thank you very much.